This is your macroeconomics video on GDP investment. Remember, the investment category of GDP is final goods and services purchased by businesses. And these are not parts that a business is going to put into a product or service. These are things that the business is going to keep. So it is spending by firms that they do not intend to sell on to a consumer. This would include anything that is a capital equipment or capital stock. This is machinery, equipment, tools that are used by the business. So if a construction company purchases really large scale tractors or cranes, those are not things that they sell to consumers. Those are things that they're going to use to make their products. It also includes structures, and the same thing goes for when we talked about housing under the consumption category. Businesses also buy factories, they can purchase houses, they can rent office space. So if you're renting space, the rental payments count because you're paying a landlord for a good or service. If they are purchasing a building for the very first time and constructing it, and they are the first company to purchase that particular building, then the entire production value of that office space or factory would count. But if they're purchasing a used building and then upgrading it or changing it, only the upgrades would count, not the used purchase price of that factory. The last part of the investment category is called inventory. Inventory are goods and services that have already been produced and they are going to be sold to a consumer, but they have just not been purchased yet. Remember, we want to count things in the time that they are produced, not the time that they are sold. So if somebody, on December 31st, the very end of the year, a lot of times stores have inventory on their shelves that hasn't been purchased yet. That would still be counted in the time period that it was produced, even if, let's say, it's produced in December of this year, but not purchased until January of next year. It would count in the time period it was produced, not bought. And they would use the price that they intended to be bought at. If for some reason that purchase price changes, like it's on sale in January, then they would just go back and adjust the GDP number. Remember, investment does not mean the purchases of financial products like stocks and bonds. That is a verb called to invest, which is a way to save. We're talking about capital I investment here, which is purchases by businesses. Stocks and bonds are never calculated in GDP, partially because they are forms of savings. They're not forms of spending. Also, there's nothing being produced when you purchase stocks or bonds. For your next chart, I decided to find the craziest chart I could, and so that's what this is. I want you to take a decent amount of time to try to figure out how to read this chart properly. I do want you to make a couple of comments on your guided notes underneath it. Remember to use the title and the two axes to try to figure out what this is saying. This is an extremely difficult graph to read properly, and we're going to go over it in class.